Welcome, everybody, to the May New York Enterprise Tech Meetup. Woo! So we heard New York Tech Week is now a thing. We've been doing this 12 years, and we decided to pregame it a little bit and get incredible group of folks across the suits and the hoodies ecosystem together. For newcomers and for longtime attendees, many of whom I see tonight, welcome.
Is this working? Hello. Hi, everyone. Can't wait to facilitate this amazing conversation with our wonderful panelists tonight. My name is Madeline Rinbarger. For those of you who don't know me, I'm a reporter at Newcomer, based here in New York City. We are a venture capital and startup-focused startup newsroom, so covering startups from a startup, always very exciting. We're founded by Eric Newcomer, who's an amazing, super accomplished reporter, was at Bloomberg for 6 years before returning, deciding to go independent and start his own company. And now we're growing and hosting our very first New York-based Cerebral Valley AI Summit, June 27th, here in NYC. So please like and subscribe for more about that after the talk. But yes, I'd love to, go down and have all of our wonderful panelists introduce, if you'd like to introduce yourself before we start the conversation, and just give, like a quick, 1 to 2 sentences about your focus area and what your, both your work and what you like to invest in. And then, of course, also we have to do an icebreaker, right? So I'm really excited to ask you all, if you weren't a VC, what would you be doing instead? Always fun. So we'll start with Sarah.
Hi, everyone. Thanks to the Workbench crew for having us. It's great to be here. Great. So I'm a general partner at Andreessen Horowitz. We're a multi-stage, multi-sector firm headquartered in Menlo Park, but we now have a nice big office out here. Come visit us. It's actually nicer than our San Francisco office. And I focus on the growth stage in particular. I lead enterprise and AI investments for our growth fund, and joined the firm 5 years ago when we kicked off the growth fund. And we sort of define product market fit as, growth stage as post product market fit, which can be a little bit nebulous, but happy to dive more into that. And then icebreaker, I would be a party planner. Yeah.
Great answer. I'm curious, why party planning?
Yeah, growth investors are not known for being the most creative. And so I feel like I love to host, and it also lets me lean into my more creative side with the theme and all of that. So, and bringing people together.
Very cool.
I love that, Sarah. Hey, everyone. I'm Priyanka Somra. I'm a principal on the team here at Workbench, and Workbench is an early-stage enterprise-focused VC fund. We're based in New York City. I cover our investments in cloud-native infrastructure, developer tools, and data. If I were not a VC, so I hear that growth investors are not super creative. Seed investors tend to be very creative. So I think I would have wanted to do something in architecture, landscaping, interior designing, something completely different from my day-to-day.
Well, I think my matchmaking future self could work with the two of you, because the one I was going to say of my other career would be matchmaking, because I love connecting companies to each other. I love connecting customers to each other, future hires. And so maybe we can do some matchmaking at the party in an interior designed house, but we'll talk about that later. Hi, everyone. I'm Grace Isford, partner at Lux Capital. Lux is actually founded right here in New York. We invest in frontier tech, deep tech, cutting edge tech, everything from space, defense, robotics to AI, machine learning, which is where I spend a lot of my time. And we're really excited for Workbench again for hosting this and to be here in New York City. Lucky to have a lot of our AI portfolio right here in New York, like Hugging Face, like Runway, like Mosaic ML, this research team that was acquired by Databricks. So thanks again for putting this together.
Awesome. Well, we have the full party stack here tonight. If we weren't in venture investing, so very exciting. Full service. Perhaps a startup in the future, maybe. Great to meet all of you, and I'm really excited to kick off our conversation. And I think we should just, start at the high level, I guess. How has the last year of the 2020 downturn, frankly, has been tough for a lot of founders and investors. And we've just been kind of a sort of recalibration, kind of reset moment that we've had in the space. But at the same time, there's been a lot of really exciting developments with AI. So it's, kind of a tale of two cities in some sense. So I'd love to just kind of, for each of you, I guess, how have you seen at each of your stages the environment kind of impact enterprise startups and investing in the space?
Yeah, I'm happy to go first. So the way that we've been looking at the current investment landscape today is that there are almost like two buckets, the haves and the have-nots. The haves are the AI startups, the second-time founders who continue to command 2021 style valuations despite the market reset. Meanwhile, if you're a startup building in a category other than AI, even if you come with the strongest team, the most innovative ideas, you're oftentimes getting overlooked by most venture funds, given the whole AI mania that's going on. So what we're seeing at the seed stage is that a lot of these promising founders are having to launch with a smaller seed raise in the early days and having to really demonstrate significant traction ahead of even getting to market and getting broader appeal. At the Series A stage, what's interesting is that capital deployment feels a little bit more conservative, right? Given the fact that a lot of the large funds over deployed at too expensive of valuations in the past. And so it's interesting because now we're seeing fewer of these preemptive raises happening. Valuations seem a bit more reasonable. And like, if you remember the 15 million on the 75 million post-money valuation rounds that we saw all throughout 2021, that's not quite happening. Series A's feel closer to the 10 million, 12 million ballpark. Valuations tend to be in the range of the mid 40s to 60s. The one thing I'll say is that even though the market is leaning more conservative, we're still seeing FOMO drive up certain deals in AI. For instance, Cognition AI's Devin raising at 2 billion pre-launch is pretty mind-boggling. So for the founders in the group, I hope when you're hearing these numbers, hearing these stories, you're not comparing yourself to these outliers because those really are just outliers.
And I mean, I'd add to that, like as the stack kind of progresses, we're seeing a lot of really incredible founders out of DeepMind, out of Meta, starting companies, and they're so incredible, particularly on paper, that they're raising pretty easily a seed round. And that seed round may also be quite large and very compute intensive. And so that's always a little bit worrying when it comes to Series A because it's a higher bar of what you need to prove. And so I'm usually looking for, I call it customer love, but it's, 1 mil-ish in ARR still to me is what I'm looking for. For certain categories and spaces, people are wondering, okay, is that true 1 mil in revenue? And if it's a really competitive space, that bar can even be higher. Huge premium for AI. And I'm seeing a lot of pre-revenue Series A's get done in AI. Very hard for non-AI companies. Even I have a company in our portfolio that's like 3 to 5 mil in revenue today. They have an excellent business, but they're raising at 60, 70 post versus the same AI company would be probably raising at 150 to 200 as an example. And really the narrative is driving a lot of these rounds, right? Cognition you mentioned is a great example, but the story that these AI companies are telling direct to their users, and it's something for all of you to think about. What is your narrative? What is your story? And that will drive a lot of your fundraise process as well. If I believe you're the narrative to be this N of one unique player in the space and have, unique talent or technical advantage, that's more interesting to me than, just a company that's coming in and doing, the 10th version of a certain enterprise AI application.
By the way, can I just quickly poll the audience? How many folks are founders in the audience? Okay. Oh, great. So mostly founders. And how many would you say are seed or Series A stage? Got it. And the rest, and then Series B beyond. Oh, okay.
Well, I'm pre-seed.
Pre-seed. Okay. Oh, okay. There's a lot of pre-seed. Okay, I missed that one. Okay. Oh, and then pre-seed. Got it. Cool. Right.
Nice. Yeah, I was going to say, in your experience, how have valuations really changed at the growth stage? I know less growth founders in the audience, but still, but it's still important to track the differences, right? And like what you're kind of seeing in this ecosystem right now.
Yeah, totally. So when the seed and Series A companies are raising growth rounds, there's a lot of parallels. It was actually really fun to hear what you guys are seeing in the earlier rounds. I definitely think maybe the difference with a lot of the growth stage companies is that, to your point, Madeline, just on 2023 and parts of 2022 being a rough time to sell software, honestly. We saw a big slowdown. We actually tracked this and across all the data that we collect on companies, and it really was 2x is the new 3x. Those sweeping generalities, obviously, but and just in terms of the average growth of companies that we see, and we tend to see companies that are growing on the faster side, so there's sort of a slowdown even among those. And I think the valuations coming down, it's a fair point on, I think you said tale of two cities or the haves and have-nots. That's definitely true in the growth stage as well. I'll take AI out of it because I think a lot of what you guys said applies to the growth stage, almost to the more extreme extent, because it's like now $10 billion valuation for 5 million of revenue or something like that. But just in terms of the growth companies that are not, and how many of the founders are building, would you call like AI companies versus, okay, perfect. Okay, so actually mostly, or half, maybe 50%. But I think the difference that I would say is for the companies that went through harder times, the valuations, I think subsequently have come down a bit. But what's been really exciting to see on the company building front is that we have seen companies become a lot more efficient and just judicious with how they're building. And so the companies being built are actually much higher quality. And I think it's, for the early stage founders in the room, you're actually coming of age in a better time to be a founder where you're not, I think the 2020 mode of like, let's spend to grow at all costs. I don't see that as often at the growth stage anymore. And so I think companies are building more responsibly. And then on the AI front, whether or not you're building an AI product that you're selling to customers, I do think the potential for AI to transform internally has been very exciting as well, whether that's, giving your developers AI dev tools or transforming your customer support. And so I think those are exciting ways that companies are becoming higher value, even though it was frankly a tough environment the last 2 years.
Yeah, definitely. And given that the environment was tough, actually, I feel like a good question for you. How much have you seen kind of like the kind of dry powder that we hear about all of the time in the ecosystem that's, waiting on the sidelines to find the perfect company? Like really, how much of that is, immediately accessible and like really in the market today? Or is it, kind of wrapped up? Or like what's kind of your lens on that you've been seeing, and how hard is it to deploy or not in this environment now?
Yeah, great question. We haven't done any deep industry-wide analysis. I know for A16Z, we'd been deploying fairly steadily even in the downturn. We just raised a $7 billion fund, and
congratulations!
Thank you, and are ready to put that to work. I would say though, even if you just look at the aggregate numbers, there was a slowdown in deployment, certainly, and so I think that is coming back in a big way. It was interesting to hear you say, Priyanka, that people are still being a little bit conservative about A's. I feel like it's changing slightly, but obviously you would know much better.
Yeah, so what we've been seeing is that, to your point, I think in 2021, funds were very quick to deploy. And so come 2022 and even part of 2023 was them trying to triage their portfolios, right, trying to make sense of what's going on. And so as a result of that, I think there's been this movement to just slow down pacing for net new investment, which then raised the bar for later stage rounds to get done, particularly those that are building in the AI spaces. And so to your point, like I think a lot of funds announced mega funds in 2022, 2023. My perspective is that they're probably going to have to make that capital last for several years, because you don't want to go back to your LPs too soon asking for more capital. And if you look at the data that's being published by PitchBook and Carta, to your point again, you are going to see that decline in deal volume across the board, right? So I guess the question then is this dry powder truly available?
One thing I'll add is there's a lot of wet powder. What does that mean? That means that's dry powder that is basically allocated for companies that may need help, bridge rounds, exit. We're seeing in our portfolio, I'm sure everyone's seen in their own portfolio, there are companies that are not, didn't quite cross that chasm or didn't quite hit that post-product market fit, or maybe raise a growth round but were burning far too much. And so those are the situations where I think funds have a lot of that powder allocated from a certain perspective, although I still think there's a ton of dry powder. I do think we'll also see a consolidation from a fund perspective over time, where there's going to be probably fewer funds and there's going to be a little bit of a consolidation of some emerging managers into these larger players who are kind of amassing more and more LPs.
Makes sense. So you've seen kind of more a lot of this. Yes, there's all this dry powder out there, but it is really allocated a lot for follow-ons, bridge rounds, like portfolio support, even, or like supporting the companies you already have invested in, rather than necessarily sourcing new deals. Is that kind of what you've been seeing? Or
I think maybe for past funds, right? I'm thinking less about like our newest fund. We've also hardly deployed it yet, and so it's a lot about the past funds that are allocated in that sense.
yeah, that makes sense. And then I guess for each of you, how, given like this macro environment, how has your investing strategy changed? Like, are you approaching companies differently, more critically? Has the diligence process changed much, or are there just different questions you'd rather ask? Like, I'm curious.
I can take that to start. I think particularly whether or not you're building an AI or not, or you're an enterprise company more generally, always asking yourself, what is your 10x differentiator? So 2 examples. One, if you're an infrastructure company, what is your 10x differentiator outside of a cloud player, outside of OpenAI, outside of the incumbent in your space? A few examples. Developer community. LangChain in our portfolio has an incredible developer community, and that enables them to move into new areas, even if other folks can build other aspects of their product. Modal, also in our portfolio here in New York, developer experience. They're really figuring out, okay, if you use Modal, wow, it's a beautiful experience. I'm really experiencing it in a way that's different, even if other folks could provide me serverless infrastructure. Sakana AI, it's a company we have in Japan, fortunately not in New York, but they are taking a totally different technical approach, like evolutionary algorithms, which happy to chat with any of you later if you're interested in that. On the application side, really think about what is your 10x differentiator, either from a product standpoint. So what is your ROI? How are you going deep into the workflow? Great example in our portfolio is Runway ML. Runway is going deep, working hand in hand with filmmakers and producers and creatives, and thinking about how do we actually take this AI product or software product and really integrate it step by step into the workflow. For me, what I really do worry about is when a company comes in and says, oh, I'm adding AI to this product, and I ask how, and they say, well, it's not really vertically integrated, it's just a chatbot, or it's just something we're laying on top. And there's a lot of dependency risks from that perspective. So always asking yourself that question, and I've been asking myself that of pretty much every company I'm seeing today, and even incorporating it into your pitch, like what is that kind of thing that makes you N of one or unique?
I love that a lot. The thing I'll add is when it comes to our investment strategy at Workbench, the thing that we really take pride in is in our consistent and disciplined approach to investing, particularly when it comes to leading seed rounds in enterprise-focused startups. And so that's when we think about what really drives our approach, it's always been a concentrated focus, aiming for meaningful ownership in the companies that we back. And despite the frenzy of 2021, the downturn of 2022, we remain fairly consistent and steady across sectors, right? And the thing too is that it is so challenging to maintain discipline as a fund when you're going through these hype cycles. But for us, it is a core principle that's really proven to be effective over time, and has really helped us as a fund to align with the best founders and align with founders who are really building for the long term.
Well, I think so. I love what Grace was saying about 10x. The one thing that I would say that comes out more at the growth stage, but you guys can prepare for now as early stage founders. And this is a boring one that people talk about already, but you really started to see separation among companies, and that was retention. And specifically on retention, and how does that lead to what you're building? Really pushing yourself on is what I'm building absolutely mission critical to our customers? And, in a period where, I was on a board of a company where they said, hey, we have 300, it was a very late stage company. They're like, we're a customer of 300 SaaS applications. We're going to cut 200 of them, just slashed, right? And so I think asking yourself, are you in that 100 that stays or the 200 that goes, right? And how do you get into that 100 that stays? And I think when times were good, everyone had a gross dollar retention of 90% plus, right? Best in class, mid 90s. But now when you look at it, I've seen companies that, have dropped to the 50s, right? And that's a very different product, and that is a very different valuation they're getting in this environment. And, you look at, other companies were like, we're investors in Figma that stayed in the mid high 90s. You can't do your job without it as a designer, developer, a front end developer. And so, I think it sounds very obvious, but seeing it, I think it's something that we don't take for granted anymore because we have seen such a bifurcation in performance.
I was going to follow up on that. I'd love to know more, like which companies really are doing that both in your portfolio, just ones you're seeing, like what makes them stand out? Like, is it, work ethic drive, like sticky customer retention, like really hands-on work with their clients? Like what I think have you seen that has made it, be in that upper echelon of of customer retention and, growth right now?
Yeah, that's a great question. And I'd be curious what you guys are seeing, but I think it really does come down to what problem you're solving and how you're solving it. And that sounds really basic, but how important is that problem to your end customer? And then have you gone specific in a way? And it does bring in like, are you 10x better? But you have to be 10x better in a field that really matters to the customer. And so I think one of the signs of that is it's not necessarily retention. That's obviously one thing that we talked about, but even ACVs, like if you're in there and you're solving a problem that your customers are only willing to pay $1,000 for, $1,000 a year for, maybe it's not that important of a question, a problem that you're solving. And so I think a lot of this comes down to what problem you've decided to solve and how you're solving it. And then of course, all those things that you mentioned are very important, but at the end of the day, great customer support can't fix the fact that if you've gone down a path that your customers don't really care about, they're still not going to spend and they're not going to renew.
Yeah, I actually agree with this. I think what you're getting to is like the more conversations you have, especially for me coming in at the seed stage where there's not a lot of data points for you to play with, right? So what we're really looking for is how creative can you be when it comes to your early go-to-market? Are you having enough conversations with folks in your perceived ICP, right? Really understanding, if I'm the founder, I'm the builder with domain expertise, I need to branch out beyond my own assumptions and test it out in the wild, gather as many data points about the product. Is this the right way to approach it? And even seeking for what are other repeatable ways for which this product could be used across an organization, right? You want to see not just today how it's being used or how it'll be received, but over time, how does it grow from an adoption perspective? So one of the things that we do, so our fund, our bread and butter is go-to-market. All things go-to-market. We help founders go from 0 to their first design partners to 1 million in ARR and beyond. And so much of that journey is the time that you spend with customers, asking all the questions. And I guess most of you may have heard of the book Mom Test, right? We all have read it on our team and we recommend it to founders too, because it really teaches you the art of talking to your customers and really getting to the nitty gritty.
I mean, I think they nailed it. Is just like know your ideal customer, who they are, what they're reading, what they're doing, be able to explain them in total depth, particularly to a Series A investor. That's a big warning sign for me at this stage. If they're graduating seed stage, they have 1 million revenue, but they don't have a clear pattern of repeatability across their customer segmentation. So really be able to articulate that. And then in AI in particular, it's easy to get enterprises to sign up for things because guess what? Fortune 500 companies, their earnings calls are correlated to their mentions of AI, right? And so you're going to see a lot of folks experimenting, but it's really critical to see if you're able to expand those workflows, if they're actually able to stay, right? And so always asking if you're seeing expansion that's really exciting within those customers or high retention, particularly with these big enterprise contracts versus just, getting a POC.
Yeah, actually, that's a great segue too, because there's no way to talk about the state of enterprise tech right now without touching on advancements in artificial intelligence. And it sounds like a lot of people in the audience are building with AI. Super exciting. There's lots going on. Let's talk AI in enterprise. I'd like to start with you, Grace, actually, since you just touched on this. Do you think that AI has kind of where in AI has crossed the sort of hype to hot? What sectors have really broken through, and what enterprise use cases are you seeing that you're looking out for and have been really promising?
So AI's been around for a while, so I'll caveat that, right? We've had companies in AI since 2013. I'll make it a little bit more specific and talk about large language models, right? Have been the hype craze of the last 18 months.
So generative AI.
Generative AI, exactly. But I have seen very few large-scale enterprise LLM use cases in production, probably with the exception of coding and customer support. We are very early still in like the enterprise adoption cycle of AI, as much as, Fortune 500 companies are signing up for POCs and trying things, but actually implementing that technology is much harder than most expect. So yes, you can plug into the API, right? I see some nodding heads here, but guess what? You got to do all the integrations. You got to do the workflow. You have to actually make this work at scale. How do you make an autonomous agent, for example, plug in and work reliably at scale? Really hard to do, right? And the technology is still in this kind of teenager phase of people using it in production. I've heard this countless times from several different folks. It's easy to have a chatbot, at large scale, but truly have a very high functioning autonomous agent product. So still very early. Guess what? There's a huge opportunity for all of you here in the room because, I do think you're going to see a lot of companies that are maybe claiming to do a lot of these LLM production use cases, not able to sustain or retain or grow at scale. And so we're still quite early. On the infrastructure side, we've seen a lot of, model development. We've seen a lot of really exciting infrastructure companies and a bit of consolidation already. Databricks announced an acquisition of a company called Lilac in the data curation space. I think you're going to see a lot more M&A and consolidation there. And so again, thinking back to what we thought about is what are you building that's truly different than maybe, an open source library that Microsoft, we're sitting right here, might launch the next day and really has that staying power.
Yeah, I think Grace hit the nail on the head. I think there are a lot of call outs for, around AI for chatbots, AI for customer service, or AI for sales and marketing and whatnot. But we're yet to see the power of what a company like OpenAI can have on the big enterprise because those use cases are not super widespread, right? So what's most exciting for us right now are really companies that are trying to drive efficiencies across different categories like HR, risk and security, healthcare.
I was gonna say, there's been a lot of really promising biotech companies too for drug discovery, health tech adjacent. Yeah.
Yeah, because I think generally, like when it comes to the adoption cycle, AI is still in the very early days. People are still trying to figure out, like, what can I run, internally in a secure and compliant way that doesn't break the business?
That's very fair. Sarah, I didn't know if you had any thoughts?
I guess to Grace's point, it is fascinating that this wave of AI has found more product market fit in the consumer market to start. I think what we've seen with very strong product market fit would be summarization. Everyone's talking about that, companionship, and then creative use cases. Grace mentioned Runway, which is, I think a hallmark company in that field. And on the enterprise, it has been, there's been a ton of excitement, a lot of money being spent. I think Accenture mentioned that they were run rating at $2 billion of revenue, helping enterprises adopt AI. So it's clearly, there's a lot of interest, and I think adoption, not more experimentation than production. It's changing slowly. But I'm very bullish, and not just because I focus on enterprise, but I'm very bullish on Gen AI in the enterprise sort of in the next 18 months, even though the last 18 months were very consumer-oriented. I think even though the product market fit has been those 3 areas that I mentioned, I will give an example of one where, and this maybe more applies to a company that didn't start as an AI company but added an AI product. But I think the lessons or the learning applies to all, which is it was a company in the sales and marketing space. They actually added an AI BDR and generated close to 20 million of ARR in a quarter. So real results. And it was fascinating because this product, what's their right to win? Well, they were actually using a lot of their data as a CRM. So the data was plugging into the AI BDR product they were using that they had put out to customers. And when they A/B tested it, when their customers A/B tested it with actual human BDRs, it did better, right? And so you actually are seeing results with, I'm not saying SDR should quake in their boots for their jobs just yet, but in this specific use case where in a specific vertical industry, there are actual results being shown in commercial use cases. And so when we start to hear stories like that, I think the product market fit is clearly expanding into the enterprise. And I totally agree with both of you guys that there's a huge opportunity out there. And it's not just like, hey, you got to go be a foundation model company. In fact, most people shouldn't. That's a specific profile. Too many of those. But there's a lot of ways that you can take advantage of AI, but you have to make sure you're really incorporating your unique assets, whether that's on the data side or whatever workflows you've already built, because we are starting to see the magic of the combo, but it's got to be done beyond the way of I think people are saying GPT wrapper for a lot of companies. I think if you can integrate those in a deeper way, your customers will see more results and they will buy.
Yeah, makes a lot of sense. Also, Priyanka, I feel like this is a good question to start with you, since we can start with seed once again.
Right.
But I guess how, as a founder, do you stand out at when you're building something interesting, but all of the hype and attention seems to be on AI? So you have this really breakthrough idea that could really save a business customer tons of time and money. You have the perfect team, but it's not necessarily like AI forward right now. Like, what would you suggest?
Yeah, I think it's a tough thing to be building a business, right? Hype cycles or not. The one thing that I tend to cover mostly investments across cloud native infrastructure, developer tools, not a lot of AI per se. So what I love to see from customers is, I think Grace mentioned this earlier, is a strong narrative for why now. That comes down to the product, that comes down to founder domain expertise, right? You may have had, years of building something internally because you face that problem firsthand and you have a very pointed view, well-informed perspective on what does the market look like today in 2024, what have been attempted in the past, and why would this approach work? But not that you're doing it in a vacuum. You're constantly trying to battle test the story, to my point earlier, with as many conversations as possible with folks in your ICP, right? Across titles, like in the developer world, there's a lot of title arbitrage, right? In ML, there are AI researchers, AI scientists, there are ML engineering teams and whatnot. So the titles are all over the place. But in the early days, I'd recommend that founders try to have a conversation, pitch the idea, try to have a good understanding of what does the tech stack look like? What are people trying to solve for right now? And more importantly, because you're not building in a hypey category, how is budget being allocated? Who is the budget owner, right? I think budgets are being constrained across the board. So it's even more important now to ask the real questions and to really understand your customer as intimately as possible.
Yeah, it makes a lot of sense. And I guess also, for all of you, whatever, we can start with you, Sarah. What are some other hot sectors you're looking to invest in, and which are you looking to avoid right now? And perhaps if there's any reason why.
Well, the latest deal that I worked on actually was not in AI.
There you go. See?
Yeah, there are other sectors. Yeah, it was a company called Wiz, which is in the cybersecurity space, a leading CSPM, if you will, and frankly, I think security in general is an area that is very interesting to us, always, but especially right now, because if you think about paradigm shifts, there's a lot of excitement that comes with those, but also a massive increase in digital threats and new important companies that are being built to help us fight against those threats. And so we think security is more important than ever. I think if you think about the shift to the cloud, that was it's been, I think AWS launched in 2006. People keep me honest, but very long time ago, right? And Wiz was founded in 2020. Has scaled very quickly since then. But if you think about that gap, right, these are not quick shifts that take 18 months. They happen over the course of a decade or decades. And so that's one area as an example that we're really excited about.
Yeah, okay. So I know Grace and I actually talked a lot about data. We jammed a lot on different ideas and whatnot, so you'd appreciate
Love
this.
a jam.
Yeah, a lot of good brainstorming happening. For me particularly, what's exciting today is to revisit existing categories in data infrastructure. The reason being that we're in 2024, there are a ton of good open source projects that are being released, a lot of academic research and work that's being poured into those. We're seeing the adoption of Apache Arrow. We're seeing the proliferation of tools like DuckDB, IBIS, Data Fusion, you name it. And when I'm talking to enterprise practitioners, one interesting point is that even though people have been processing data and analyzing it and querying it for like the longest time, there are opportunities to optimize these broken, outdated workflows by leveraging the next engine that's available, right? Folks want to be able to process high volumes of data, but they want to do it in a way that preserves the performance of their engine, doing it in a reliable way. They want to query data, but they want to do it in a cost-effective way, right? And I feel like if we're able to leverage these next-gen engines, there could be something interesting to figure out there in terms of optimizing next-gen workflows. I've actually spoken a lot about it in my Substack called The Data Source. So if there are any founders in the audience want to talk more about the topic, please come find me later. I have a lot of thoughts to share on this.
It's an excellent Substack. I've been subscribed, I think, since the beginning, I like to think. But I got my start in venture, right, looking at the modern data stack and the emergence of the modern data stack and all the open source data tooling spinning out of LinkedIn and Uber. And something Sarah and I were just talking about right before is what is this emergence of the modern data stack or data stack 3.0, may I name it, that is fit to the new generation of not just supporting, a lot of AI apps, and whether or not you're an AI company, companies will need to have infrastructure that is fit to be powering, a lot of these AI applications. And that could be streaming architectures, that could be DBs, that could be a lot of other things on the DevOps and data ops stack. And it's still very emergent, but thinking about, okay, how does my company really advance the future of the infrastructure stack is something I've been thinking a lot about. And I think a lot of money will be made, just in the same way as we saw with the cloud migration. One other area I'm really excited about is just vertical software stuff. A few examples: vertical software in chemistry, in material science, in biology. Lux has always done a lot of cool stuff, the intersection of tech and science, and there's a lot of proprietary data sources there. There's a lot of proprietary data sources in manufacturing, supply chain. So any vertical software where you're solving a real problem with high urgency, high retention, high frequency, guess what? That's also going to be poised to take advantage of AI in the long term. But just start with software. You're probably already solving a huge problem there. And guess what? That's your story and narrative to me as an investor. If I'm asking, hey, where's your AI? Oh, no, I don't need it yet. In fact, this is providing such a huge ROI. We're getting access to all this data. And over time, we are poised to have, one of the best models or integrate with the best players in this space.
Totally. I want to open it up to questions from the audience in just a minute, but I wanted to ask one more question for each of you before we open up to the floor, which I'm really excited to hear what everyone here would like to ask our amazing panelists. But yeah, if I'm switching it more to a sort of a founder perspective as investors, what advice do you have for founders raising around in this environment? And are there key milestones or metrics startups need to show at each stage? And what would you say is your best advice for a founder who's maybe wanting to pitch you someday, potentially in this audience?
I can go first. So I think this is probably where I'll have a slightly different perspective from Grace and Sarah, given that we're seed focused and I'm really focusing on technical categories. So what that means for us is we're investing in companies way before they're able to generate meaningful revenue. So our diligence process doesn't quite rely on ARR numbers quite yet. Instead, we are very thematic in our approach. We're spending a lot of time talking to practitioners across the board, across verticals, to really understand what are the top enterprise pain points today, where is real budget being allocated, what are things that people are trying to solve right now, and we use these as guiding points to really help us identify the best founders out there. And so that's kind of the framework for how we've been operating over the last 10 years of Workbench. The other thing too for us is that we've really valued investing in founders who were operators, right? So for instance, Robert, the founder of Fire Hydrant, he built incident management software based on his experience as an SRE at Namely. Paul, the founder of Visor Trust, he was formerly the CISO at ASAP, and he's building software to automate third-party cyber risk management. So we're really looking for that sort of domain expertise where you could really understand the core of the problem, and then commenting more so on open source where there's a lot of noise, a lot of buzz happening. We're looking for projects that are addressing real problems, but also that have really strong user engagement. But beyond beyond that, and more concretely, we're really looking to understand, is there a real path to commercialization here? I find that a lot of early stage founders building in open source are not quite thinking about monetization, but that is the most important thing that you should be doing on day one. So really understanding, is there a viable business opportunity to be made out of this project?
Yeah, I can continue. I'm always looking for, like a variant insight. And by that, I mean, what are you teaching me? And I always love going to a pitch meeting and coming out and learning something new, right? And so, what did I get wrong about this category? Why are you different than every other person that's come before? What is unique about this current time? And maybe what's a new technical shift? What's a new, platform shift? What is an approach you're taking that no one else has taken? So there's just one thing to think about. It relates to what we said earlier, is what is N of one that you're doing or unique compared to others? And then, why are you the best person to build it? At Series A in particular, you mentioned earlier, customer love. Show me that customers love the product, that there's high urgency. And I don't necessarily always need revenue, right? The more revenue, the better. But you can manifest that in different ways. Maybe you have two large, amazing design partners who are singing your praises and are saying, I could not exist without these guys. And so really being able to articulate that urgency is really critical too.
Yeah, at the growth stage, we're much more metrics focused. Rather than boring you with the sort of details of what we look at by any given stage, one of my partners, David George, actually wrote a great piece. I think it's called The Year of Greatness or something like that, that he actually details what we do look for. So I direct you to that piece. I'll actually end with maybe a common don't do versus what we look for. And I see this a lot. It might sound obvious, but when you are sizing your market, which is tempting, it's a natural question you get. Hey, how big is your market size? Especially if you're in the category creation phase, the watch out that I would have is make sure you don't size the market too small or too big, because the investors will either think that you know a lot more than they do, or you don't know what your market is. And on the small end, the reason that's dangerous, we've seen founders who are building great companies, but they'll sort of come to us and say, and my market size is 100 million. And that's a great number. I mean, it would be amazing to get to that revenue scale, but I think just sort of the inside baseball on what the math the investor is doing is like, okay, well, let's assume, unless you're vertical software, right, you're probably going to get, if you are a huge winner in this market, you're going to have 25% market share. You'll tap out at 25 million, and usually founders overstate their market size. And so if you're telling me it's 100 million, it's probably 50 million, right? And that's an extreme example, but it's just one sort of watch out as you guys are pulling that dreaded slide together. I'd almost leave it out rather than have something like that in.
Actually, one way to replace that slide, at least I look for a Series A, is maybe your Act 1 is you are just a software company serving enterprise user. Act 2 is maybe your sales and marketing, that company you mentioned earlier. Act 2 is you're actually going to expand beyond and leverage that data to provide new insights. And Act 3 is you're going to be the AI immune system workflow for this organization. So portraying where you can go and grow the product is what I'm probably thinking about looking for more. It also shows me you have vision and ambition, right? And that you're looking for the long run. And that also probably will help as you get to the growth stage of, wow, yeah, their market might be a little bit small today. Oh, but guess what? They're going to expand here and here. And I can see that logical tie.
Really good advice. And on that note, if we have any questions in the audience, I'd love to hear from you. If you're able to, shout it out, I can repeat the question back so everyone can hear it too. But yeah. Oh, go ahead. Yes.
Yeah, I have a question for Sarah. You guys talked a lot about valuations and everything of startups, and looking at the later stage for companies that got raised money from Tiger or someone else. To what degree have the valuations reset within those businesses, and have all the down rounds occurred, or how much more of that do we have to go through before all of that's worked through?
Yeah, just to repeat real quick for people if you didn't hear, at the growth stage, there was a ton of capital flowing in 2021. There were these super huge rounds and valuations, and now a lot of these companies presumably will have to raise again. And so, where are we kind of seeing that play out now today, years later, and what are you seeing at the growth stage?
Yeah, so there have been very few down rounds, and I think it's the very logical question to ask because people raise at astronomical valuations, and it leaves very little room for error. But then at the same time, we hit basically a tech recession. And so, that room was not left. That being said, alongside those valuations came a lot of money. And so those companies, if you work backward, raised 4 to 5 years of runway in a lot of cases. And I think people are more judicious with their spend. And so we haven't really seen that wave hit on the growth side. Obviously, there's a couple of exceptions with that. I think Klarna raised a down round, things like that. But in terms of companies not necessarily at the last round valuation, I think it's pretty common, and it hasn't really rolled through yet. How that will play out, I think a few folks are, on the topic of second act, are finding their second act, and that's been very exciting for those companies. There's probably a wave of consolidation coming. Some of that has started in terms of companies deciding to join other happy homes. So certainly that. But no, I think we're still at the beginning of seeing that wave wash through the later stage companies.
Really good question. Thank you. Oh, yes, you.
When you look at particularly seed stage, one of the things I always ask is, are you asking a company to spend their money differently, or are you asking them to create new allocations? So when you look at a startup, are they creating a new category versus trying to get companies to change how their budget? Can you talk about how you look at that?
Yeah. So to just repeat, at the seed stage, are you asking how are you talking to companies, and what are you seeing on how they can allocate differently or create differently, and especially on their customer base, what do you evaluate for that market, and how do you differentiate?
Yeah, that's a good question. So at the early stage, when founders come to us, they usually state the price, the number that they're looking to raise. And our question back to them is, what are the key milestones that you're trying to hit with that number, right? So let's say it's 3 million for your seed across product, hiring, go-to-market experimentation, thinking about all the different things that you would need to do to get the product in as many people's hands as possible. What are the milestones associated with that? Let's say for someone building in the developer tooling space, where you need to potentially hire, let's say, 5 back-end engineers, and engineering hires are very expensive. So you have to think about what is the market comp for that, and we help pair them up with resources that we have internally, with playbooks that we have from our advisors across sales, product marketing, et cetera, and we really help them understand, well, for, let's say you're aiming for 12 to 14 to 18 months of runway, here's how you could distribute money across those different milestones.
Yes, go ahead.
So there have been a series of different hype cycles, right? Certain themes that we've all experienced. Right now, of course, it's AI. Previously, you might argue that it was VR, and just before that, crypto. You might sequence it in different ways. Each of these has had a proportion of validity versus nonsense. And if maybe you just take those three, if you agree that those are the last three we've experienced, looking back and now looking at the present, where would you set that proportion for each?
I can take it to start. It's a great question. How I think about it and how I kind of view my job is like following tech trends and following really smart people, particularly at the seed and Series A stage, is like, where are the smartest minds in the world building? And then the second question is evaluating what they're building, right? And so I think actually for all of those trends, and we could argue about direct proportions for each of them, there are probably potentially up to 80% or even more that is, for lack of a better word, not really, strong, viable products, doesn't have product market fit. In some cases can even be, a lack of a real product, or in some cases even fraudulent, right? In certain cases, all the way up to true product market fit. And in every one of those cycles as well, there is, a solid 20% or more, right? And it's still hard to tell for any of those, because in many ways I think they're all still emergent tech categories from a great extreme that are really amazing builders, right? And so I think it's our job to suss out, right, what is the difference between those two? How do I do it? talking to experts, talking to technical leads. I'm lucky, I went to Stanford and know a lot of professors there. So calling up a professor, calling up a postdoc. Hey, did you see this technology this person's claiming? Whether it's ZK proofs in crypto, whether it's the next, VR thing. We actually backed, the former Oculus lead who then started Andreessen, right? So, how do you go and vet that technology? Go to Chris Ray at Stanford and say, hey, Chris, have you seen this before? And getting a lot of those perspectives to help ground it. It is also part of our job, right, to take risks, right, and see what could be and be optimists, right? And so I think we're not doing our job appropriately if we aren't having some zeros as well. So taking big things, seeing where we can get, and being able, at least at Lux in particular, to de-risk the technical risk you're taking in some of these trends and doing references.
Yeah, I'll add to that by saying that, at Workbench, we're very enterprise focused. What that means is we're spending time over the past decade, we've built a network of Fortune 500 buyers right across the board. So we're hosting quarterly roundtables, gathering VPs of data, infrastructure, security, across verticals even, right? I have a partner on my team who covers enterprise apps, right? So HR, marketing, customer service, and we're doing these curated topical conversations to hear firsthand from the buyers, right? The buyers will tell us whether a category is worth investing or not, because it's very easy as an investor to go and chase after every shiny object out there. And trust me, there are so many companies to be putting money in. But by having these conversations, we're able to understand, one, is right now the right market to be betting in a category? And if so, is there a budget, a real tangible budget? But also, are there repeatable use cases for how this product would be used, right? I know at the seed stage, things are a little bit more abstract. So by really leaning in on those enterprise conversations, especially hearing from the buyers first, we're really to get through a lot of those questions.
Yeah, I'll maybe decline to comment on the crypto AR VR only because I don't invest in those areas, and so I'm not equipped to comment there. But I will just share one thing on the AI piece. And Grace is totally right. AI is not new or anything. It's been around for 60 years. But in terms of what you're talking about, the generative AI craze, I think one thing that we found really exciting is that you've probably seen that chart floating on the internet on time to 1 million users being truncated, right? And you see it sort of Netflix and Instagram, right? And all of those. And then ChatGPT obviously came in with 5 days. What's been really exciting is we actually have many companies that have beaten 5 days. Like people are getting there in a day or, a few hours now. And so that's been really exciting. Obviously, you can raise, hey, are these users sticking? Are they tourists, et cetera? But given I'm a growth investor, what I find really exciting is that the time to 100 million of revenue has also drastically shortened. And that is why we're seeing a lot of big valuations. You could argue maybe they're not all deserved, et cetera. But that's certainly the nature of venture. But I think that time to the shortening time to real revenue, and not just the OpenAIs of the world, but I won't name all the companies, but we've seen many in that category now, is very exciting and very different than prior waves. And I'll just tie it actually to your question on just valuations, because which I thought was a really interesting one as you look back. I will say, regardless of how the market is behaving and what valuation you could get in the market, clearly, a few years ago, founders were sort of advised to just take the highest one they could, usually from Tiger. And some of those companies are now stuck. And I think what's been a much more sustainable strategy is not to just take, and it sounds very self-serving as an investor, but this is what I'm advising my own companies, not to just take that astronomical 10x markup on your company just because you can, or you feel like you've caught the right end of the hype cycle, but to really, the companies that have showed steady progress and demonstrated, to the extent that it's possible, right, up rounds that are, I think, I don't want to use the word steady Eddie, but it feels that way, where you're showing progress, you're raising at up rounds that aren't astronomical, and they do leave you wiggle room not to just grow like that. But, a lot of our best companies grew like this, right? And that's still an awesome growth path because you're ending here. But the journey does matter. I think that's sort of the lesson coming out of that period of time, certainly. And regardless of what the environment is like now, even if you're building an AI company, I do advise our founders personally to adhere to that, because it really helps later on when things don't go up to the right or vertically, and you're trying to hire execs who are in it for the long term and don't just feel like your company's out of water or underwater and things like that.
Really good advice. I think we have time for one more question. Oh, yes, you.
Hi, my name is Gaurav. I run a procurement software company called Propal. My question is to Sarah. We are a Series A company, so you mentioned efficiency is something that's being you're seeing across the board with founders. I'm curious, is efficiency being valued more than growth in growth stage rounds, or is growth still valued way more than efficiency? Because in public markets, growth gets 3 times more value than efficiency. Right?
Yeah. So to repeat the question, great question. Focus on at the growth stage. What's more important these days, growth or efficiency, when you're evaluating companies?
Yes, I love that question. And I feel like a lot of our founders are like, I have whiplash from what my VCs are telling me. So, maybe that's partly reflected in the question. There's 3 venture investors in this panel. Growth is absolutely, I think the dominant thing we look for. But responsible growth is certainly more important than it was before. And, the advice that I would give is, especially, you mentioned your Series A, I think when you're seed Series A and you're trying to find product market fit, it's probably not the top thing that I would worry about because you might spend a little bit more to get there, right? But you're not at your steady state yet. And so it's not going to necessarily deter. Obviously, there's exception to this if you're burning 100 million to get to 1 million, right? There's, which I've seen companies do. But I think within reason, it's definitely not what I would, and the early stage investors should confirm that. But I think there is certainly, growing efficiently is certainly top of mind for growth investors. And that's not to say you should be profitable or not burning, right? But people will look at things like gross margin adjusted CAC paybacks, right? Maybe you're burning a lot, but those still look good. Investors want to make sure you're not throwing good money after bad. That's sort of the key thing. It's not that you shouldn't be burning money, but that, hey, you actually, there was a time period where you could, people call it lighting money on fire. You could sell $1 for 50 cents and grow very quickly. But those businesses don't end up working in the medium term or the long term. And so I think it's more about making sure you're building in the right way, not necessarily that you have to save every penny. And certainly investing in growth, I think, is very much rewarded, both in the public markets and at the late stage markets.
Can I just add to that? I totally agree, is really thinking about where the company is going from a growth perspective. At the early stages, I often find, we're really encouraging this like hyper growth and grow at all costs. But you want to make sure, a common mistake I see is you don't overhire before you've really proven out that product market fit. So a biggest warning sign I usually see at a Series A stage is the company has fake signs or early signs of product market fit, but they hired a full sales team, right? And that's a great example of, you maybe are optimizing for growth over efficiency. And the real problem is that you may need to figure out your product market fit issue and go back to the drawing board with your customers and maybe lay off that sales team, unfortunately, right? In order to truly get to that hyperscale growth.
Wow. I have learned so much on this panel, and I have really enjoyed this conversation. Grace, Priyanka, Sarah, thank you so much. And I don't want to keep us any more from the drinks and snacks, so thank you all for coming.
Thanks so much. Let's give one more round of applause for the great panel and moderation. So it was awesome to see such a packed house tonight. We're going to be taking off a couple months for summer from the Enterprise Tech Meetup. We'll be back in action in September. In the meantime, though, over June, July, and sometimes in August, we're going to do more focused events. So if you're not on our newsletter, join it at work-bench.com. We've got some of our next New York events targeted after specific functional or tech-focused areas. So hope to see many of you there. And for now, enjoy the rest of the drinks and food. Thanks, everyone.